Hello again, everyone. This is Ken Weber, president of Weber Asset Management. I'm here as usual in New York, joined by my partner, Jack Bowers, out today in Reno, Nevada. Hi, Jack.
Hi.
Yeah, today is October 27th, and we have several topics, as always, that we want to go over. And Jack, the hot topic for most people, at least for the last couple of weeks and going forward for a few weeks, is the supply chain issue and problems, along with labor shortages. So let's just jump right in with both feet. What is your take on the bottleneck that's happening at the ports, and let's talk about that right to start.
Sure. The common denominator is clearly not enough people for the jobs available to meet demand, and companies are clearly struggling with this, especially in the transportation sector. And it's somewhat short term, but also somewhat long term, because roughly about 1.5% of the workforce that we lost, at least for of the population that is working, was due to early baby boomer retirements. I think over the last 18 months, we've probably seen 5 years worth of boomer retirements. And while a lot of young people are taking time off temporarily and then coming back or switching jobs, there's a lot of turnover going on at the same time. The boomers are kind of focused on travel and other opportunities, and they're not coming back. So this is kind of a permanent loss. And a lot of these were highly skilled jobs or very specialized jobs, and it's going to be tough to find and train the people to replace that. So companies are kind of just having to get by on what they've got and figure it all out. And in some cases, they've been able to shift the workload to the customers, by forcing customers to do things online rather than handling phone calls. They, eliminate a lot of labor that way, labor they don't have. But at some point, companies are going to have to staff for the levels of demand that they have. And it's going to be a while before there's enough people coming into the workforce to make that happen. So meanwhile, the wages are going up sharply for the companies that are desperate to fill certain positions.
Which is great for the workers.
It is. And as most companies go, they're not having any trouble passing along those added costs. I think consumers are relatively accepting of the increases on the assumption that they're probably one-time deals. I think the only place companies are starting to find a little bit of trouble passing along the costs is probably in the consumer staples sector. But we don't have a large position there in our portfolios. So as a result, we're in the middle of earnings season now, but earnings are very robust, just like last quarter, and companies are doing well. And I think even there's a lot of capital spending going on right now. The automation efforts are clearly a focus for a lot of companies that are struggling with finding enough people. So we may come out of this okay if automation, a lot of times people think about it as machines replacing workers directly, like you might have in a factory. But I think more often it's automating through technology and doing processes different, especially in the service sector. So it's kind of a big time investment, and it takes a long time to put it all together.
Yeah, we're getting a little bit. That is all true. And by the way, I watch and read a lot about this. Your take on the baby boomers, I hadn't really seen, but I'm sure it's quite accurate. That baby boomers, and be careful what you say, because that would be me. And I have no plans to retire in the
Me too. I have a lot of friends who, I'm surprised they retired. But they just work became unpleasant because of the way the employers were forcing these mandates, or the government was forcing these mandates, and so they're just like, I don't really need to work right now. I don't think I will. And so it's a surprising number of people kind of came to that conclusion. I think it's mostly people who are going to probably retire in the next 5 years anyway. But
fortunately, you and I started our businesses as almost as a hobby, as something we cared about. And so we don't really feel we're going to work every day. We
Right.
enjoy talking to clients.
Yeah.
We enjoy doing the research.
As far as the mandates go, they haven't really affected me at work. So my work isn't any more unpleasant than it usually is. Sometimes a bit more of a scramble because other companies aren't delivering, but really in a financial business.
But do you have any particular take on the, 60 ships out docked outside of the ports in California? Anything short term?
Yeah, well, it's
loosening up there.
Those are mostly low value goods because anything that's really important to company earnings is getting flown right now. So these are kind of Christmas holiday retail cargo that just can't afford airship rates because it would be priced out. And so I don't think it's going, it might hurt the earnings of Walmart or Costco, but I don't think this is,
yeah, I see it as a short term problem.
Yeah.
Clearly, FedEx and a lot of the companies and the government's getting involved with some mandates of 24-hour operations. So it'll be, somewhat painful, somewhat inconvenient for some small stores, toy stores, for example. Yeah, they'll feel some pain, which we feel, badly about, but clearly it's a temporary situation. A month,
and it isn't just
3 months.
ports. It's as much a trucking problem as it is
very much so,
a
yeah.
ship port problem. And until they can get enough truck drivers to move stuff, that does get unloaded, they really can't, move any faster. So that is really the struggle. Not enough truck drivers. It'd be nice if we had self-driving trucks these days, but that's probably 5 years away. So we've got this now problem, and we just have to deal with it.
Yep. So yeah, I'm sure there's a lot more we have to say about that, but I want to move to several other topics.
Yes.
Let's touch on energy prices. Obviously, gasoline prices, for example, are about $1 a gallon higher than they were just a year ago. There are many reasons for that. But let's talk about that for a minute or two or three here.
Sure. Normally, higher energy prices hurt, and if everything else was normal, this might have a slowing effect on the economy. But nobody's going to lose their job because energy prices are high right now because there aren't enough people to go around for the jobs there are.
That's true.
So I don't think you can assume that energy is going to slow the economy this time. Higher prices are going to slow the economy. It does, of course, add to inflation at a time when wage rates are already pressuring inflation a lot. So it may mean that this inflation problem is with us longer because it now becomes not just a wage problem, but an energy problem, and that rolls forward. But it's just kind of, in my mind, a bit of a blip on the radar screen, one of several results from the labor shortage, so I think the US is in a better position than most economies because we are already rapidly shedding our dependence on oil, not only through, the electrical grid, but also through the vehicles. And I think given that we have embraced the online economy as well as we have, Zoom conferences, everything else, there's ways, we're probably substantially more energy efficient right now, the way everything is being done. Not that we want to stay that way, but by the time we return, a lot of what we use fossil fuel for now will probably be powered by electric. I think I read electric car sales are up to 2.5%. I can see that.
Well, the big news
in 3 years. So.
Yeah, the big news from Hertz and Tesla in the last couple of days. Personally, I think that's a huge push forward for the EV market, electric vehicle market. You and I are both Tesla drivers. And having Hertz buy 100,000 vehicles, electric vehicles, I think really is going to change the mindset of the general public.
Yeah, most people that actually get behind the wheel of an electric car like it, but they don't think they're going to like it until that moment happens. And so, I think that's why the Tesla stock went up so much. This is kind of free advertising for Tesla. Tesla is probably never going to need to advertise. So it changed the game a little.
I saw this morning the interim CEO of Hertz was saying people who get behind the wheel of a Tesla or any electric vehicle are 3 times more likely to buy once they're actually behind the wheel.
This is something we've long known. I've been giving friends and just interested strangers. I've been putting them behind the wheel of my Tesla for 10 years. So yeah, it definitely changes attitudes. So
Yep. That's basically what happened with me. Right. So we've already sort of touched on it, but inflation, the question is, how long is this current spurt of inflation likely to last? We talked before we started here. I think it's somewhat temporary, but it is always temporary. So let's define what we mean. How long do we think inflation at 3-4% is going to stick around?
Yeah, well, you have to go back to what happened. About 25% of the dollars in circulation today were printed last year. So you can't do that without some effect. And, the money has, limited places to go in the pandemic. So most of it has either gone to real estate or the stock market. Or to rising wages. But that increase in the money supply, which is technically reversible if the Fed takes enough off their balance sheet to compensate, is rippling through the system, and it's changed a lot of things. So much like in the late 70s when energy prices quadrupled, and that had to ripple through the system, this big monetary expansion is probably going to be the same way. It isn't going to be as bad, and it probably ripples through faster. I think we're at around the 5% level right now. It would not surprise me if that persists for a few years. I think
I would disagree a little bit. I think the Fed will likely take some action to moderate inflation. So I could see a year of 5%, but I think it's going to come down.
Yeah, if they get enough people coming back to work, that really solves the supply chain issues, and then a lot of inflation disappears. Probably we don't go back, but we stop going up as fast. So and I think Powell is feeling like the supply chain problems will resolve pretty quickly at some point, but a lot of them are long-term things. When you build chip factories to build more chips, that's a years and years type of
several
thing.
years.
So, the bigger issue is because people couldn't spend on services or don't want to spend on services like vacations and other things, they're all just buying stuff with that money that they have. And that's kind of, increased the demand for stuff and stress the transportation system for stuff. So that a lot of the supply chain stuff is or supply chain constraints are due to buying stuff. So at some point, people get to go on vacations again as the travel restrictions are eased and become more willing as the number of people in the hospitals go down. And then people start spending on services, and it takes the pressure off stuff. So we just don't know when that's going to happen.
And by the way, we didn't even touch on the COVID issue with the kids on the verge of being vaccinated. Hopefully that starts to really bring the numbers down in terms of new cases, hospitalizations, and so on. And I think as that happens and people feel freer to go out more and do more things, that should help the economy as well.
Yeah, I think we're in the U.S. reaching pretty high vaccination rates, and the children were the missing piece because that allows the schools to get back to normal. So
we're still, by the way, we're still below like England and other countries in terms of total vaccination, but we're getting there slowly.
Yeah, but England vaccinated most of the people with the AstraZeneca shot, which has a really poor effectiveness against the Delta strain. So we're in much better shape because it's mRNA vaccines that most people in the US have.
Correct. Yep. Which leads us to the market outlook. That's something we always want to close on. We have the short term. By the way, let me just say, when you mentioned Powell, for anybody who doesn't realize, that's Jay Powell, chairman of the Federal Reserve, who I personally like. I was hoping he would stay, but the rumor mill is saying he won't stay. He won't be reappointed, but time will tell about that. Market outlook. So let's touch on what we think for stocks and bonds over the next 3 to 6 months.
The earnings are really robust right now. And we have a lot of inflation, and the Fed is starting to move in the direction of tightening. So I think what we're going to see is interest rates rising to reflect the rate of inflation that is longer term.
So let me stop you right there. interest rates rising, the current rate on a 30-year bond right now at the Treasury 30-year is 1.9%. I don't understand who's buying something for 30 years and accepting 1.9%, but apparently people are. So when you say
Our trade partners are kind of because they have to,
yeah,
you
they
know,
have nowhere
otherwise
else.
they get priced out of the world market if their currencies get too expensive. And if
That's
they're
correct.
trading a lot with the US, they have to buy something with their money to recycle the trade dollars. And
Right.
a lot of it goes into treasuries, even though it's kind of a losing bet relative to inflation.
And what you're saying there, by the way, is that in spite of all the troubles with the US politically and economically, we're still seen as the place for the world to keep their.
Oh yeah, our trade deficit's going up, which means we're buying more stuff from other countries than they're buying from us in an increasing fashion.
Well, what I meant is our currency is still seen as the world's
Yeah,
stable
yeah.
currency.
Yeah, I think the dollar is gaining strength right now just because you know, we are our economy is in a position to stay stronger and bounce back faster than most other large economies based on the way we've handled everything.
Right. So for the stock market over the next quarter or two?
Well, the earnings are really robust. So it's really a question of earnings versus inflation and higher interest rates, which has a negative effect on stock prices. So I think, you know, anytime you have inflation and rising interest rates, that puts downward pressure on PE ratios. And we are probably almost certainly going to see some of that, you know, in the next few years. But at the same time, earnings right now are rising at a rapid clip, perhaps at a robust enough pace that the PE shrinkage will not be all that noticeable. So I remain concerned about wage inflation, especially on top of the inflation we're already seeing with the supply chain. And that, you know, is a big unknown how long that lasts and how bad it is. But I'm optimistic that, you know, things won't get too much worse than they are now. I just don't know how long it's going to persist. So I think everybody should be prepared for the fact that PE ratios might shrink, but at the same time, stick with their positions because we've got really good earnings going on right now. I think the only maybe tough situation is for bonds. It's really hard to find a way to do well with bonds the next few years. So
well, for our clients, we're using bonds still as a ballast to reduce volatility.
Yeah, we have to
in the
because it's the only
portfolios.
way. Yeah,
It's the only way. Yeah.
So I've, you know, gone real short term on the high quality positions, and for the rest, we're kind of embracing high yield. You know, when inflation is going stronger and companies have good pricing power, which most do right now, the default risk with high yield is very, very low. So you can tolerate, you know, really narrow spreads like we have now and still be reasonably confident that these bonds will do well because they're generating, you know, the only income stream in town, really. So so anyway, that works. It doesn't work as well as stocks, obviously, but it's a way to at least avoid losses on the bond side.
So cautiously optimistic. For the record, Jack is a little bit more optimistic than Ken. I'm concerned about the market a little
normal.
bit.
Yeah.
That's normal for the last couple of years. 10 years ago is not the same, but for the last couple of years, I've been more concerned. And right now, for example, over the last 12 days, the market's been up 10 days. So just from a technical point of view, I think the market might be getting ahead of itself.
Yeah, and no question, a lot of tech stocks are ahead of themselves right now.
Yeah.
Very large
So
PE ratios. So.
A 10 or 15% drop is not beyond question, but I would agree that if and when it does happen, I'm telling clients, I think within 2 or 3 months, it'll bounce back. So
the high prices are somewhat supported by the earnings growth. It's just that once that earnings growth slows, which it could next year, then you have to kind of watch out because then the PE ratios will come down to what the market thinks is appropriate longer term. So yeah, it's a very, last year was easy, you know.
No year is easy.
On tech disruption and you like trounce the S&P. This year's tough, trying to figure out whether growth is better or value is better. It's been kind of a struggle. So I'm just kind of at this point happy to keep pace with the S&P.
Yep.
The other issue is larger companies are more labor efficient. And so this definitely, the labor shortage kind of tilts things toward large caps in terms of being the best place to be.
Yeah, and that's seen in the S&P doing
Yeah,
quite well.
so at some point, I think the labor crunch eases a bit. So I haven't given up on the smaller stocks yet. The select model in particular is heavy and smaller stocks and kind of runs more with a Russell, or at least somewhat with a Russell.
The Russell Index, yeah.
Yeah, has been struggling as of late. But
Yeah.
at some point, I think, things kind of adjust a little bit and the discrepancies narrow. So we're pretty balanced between growth and value. I think that's kind of the continuing place to play it for 2022. Haven't really been uncomfortable with our positions, so I haven't been making changes as of late, and there's nothing really on my mind to do at this point. I'm pretty comfortable with where we're at heading into the next year.
All right, well, we're at our time limit. Happy Halloween to you and everybody around who's watching us. Have a safe holiday if we don't speak to you before your holidays. Good talking to you, Jack. See you next time. See you all next time.
All right, bye-bye.
Bye-bye.